This is one of the oldest numbers we look at, industrial production. It goes back to 1919. And the biggest drop we ever had was the new revision from a minus 11.2 last month to minus 12.5. Never been worse than that. But this month, reversed that, up 1.4%. And it actually is about half what we were expecting, unlike retail sales, which was off the charts. And on utilization rates, we moved from a slightly revised 64% to 64.8%. And 64% is the all-time low utilization rate, but unfortunately, it doesn't go back to 1919. That part of the number only goes back to 1967. Now, let's get to the markets. You know, if before our time zone, before we saw the great retail sales data, we saw the DAX, the CACs, bond yields, everything stacked up, and I'll show you what I mean. Here's an intraday chart of 10s. It reflects the retail sales and some of the strength we're seeing in pre-opening equities. So, look what happens when you put 2 days in a row. Yesterday's session and today's are stacked, meaning today's low yield is higher than yesterday's high yield. It's the same way it was in bonds. It's the same way it was with many stock markets around the world. Their lows today were higher than their highs yesterday. And that is a powerful dynamic that really gave us a good headwind coming in, a tailwind, coming in. And when retail sales hit, you could see that yields popped over 0.75%. And even though we've been up here before, it really did reverse what looked like we were going to retest into the low 60s over the last several days, especially when we had those big down days in equities last week. Finally, the dollar index. Most of the time, the dollar index thrives more lately when there's more nervousness and tension and agita in the world. So you look at the 2-day chart, and granted, it's coming back a bit, but it definitely drifted from yesterday. And do remember that today's lows, right around 96.40, represent another retest of unchanged on the year, which we have been toying with over the last several weeks.